setting yourself up in a way that is expected by investors. So most companies will set up a stock option plan. And I don't know, your speaker previously probably talked about LLCs versus corporations. When we do set up companies with clients, invariably there's two reasons that we end up setting up sometimes S corps and then C corps once you have more than one class of stock, but corporations versus LLCs. The first one is that venture capitalists typically are dealing with investors that cannot be part of a pass-through tax entity, which means that they can't be investing in an LLC. They have to be investing in a C corp, which is not a pass-through tax entity. The other reason is that if you want to set up a stock option plan, you have to have a corporation to do that versus an LLC. There's ways to do kind of options in an LLC, but it's just not traditionally something that most employees understand, and it's harder to really describe to people. And so I just think as a practical matter, people want to see option plans versus some type of option in an LLC. So that's why you see option plans being set up. So you look at it, okay, well, what would traditionally be what we call the option pool of an option plan set up? And generally it's 10 to 20% what is known on a fully diluted basis of the capital of the company. That's the size of the plan. And these plans are set up, we do them all the time. We basically have form of documents that we do for clients. We do flat fees and just say, okay, if you really want one of these, we can set it up for you for X amount of dollars and then put it in place. The venture capitalists like to see them, frankly, because they want you to have something in place that is going to incentivize your employees. It gives you the ability to offer these to advisors, directors, and sometimes people try to use it in lieu of compensation or as partial compensation for various people involved in the company. So again, it's all about setting these up in a way that a venture capitalist is going to expect when they come into your company and have an interest in investing in that company. The next thing or area is voting rights. Like common stock, preferred stock shareholders have just corporate code voting rights to vote for directors and other specific matters set forth in the corporation code. Preferred shareholders typically have specific voting rights that we call protected provisions. There basically be certain things, and these will be set forth typically in your articles of incorporation when you do deals that involve preferred stock, that basically say that unless you get the majority of the preferred stockholders to approve a particular transaction or type of transaction, you cannot move forward with it. You can't do the deal. And so it's interesting, sometimes people think, well, if the preferred shareholders don't own at least a majority of my company, then I still have control. You don't. And that's just something to get comfortable with, because they can literally own as little as 10, 15% of your company, have these protective provisions, and as a consequence, control various aspects of what your company can and cannot do. So it's something you need to get comfortable with as you get into these deals, and that's why it's kind of critically important that when you get involved with a VC, not only is it about the money, not only is it about the industry knowledge and the contacts they have, but really vet them from the perspective of, are they a good fit personality-wise, or at least with the people that are going to be involved in your company from that VC fund. Because it's like a marriage. And if you don't see or have a common vision for the company going forward, or they're just got a certain personality that grades on you, honestly, I wouldn't do the deal if there's any way you can avoid it, because it will become an issue later, because they will have these protective provisions. And if they don't see eye to eye with you on various directions that you want to take the company, they have a way to block it. And it will become contentious. And frankly, even when you go in with VC, it's a great personality fit, all of that, things change, the company isn't as successful as everybody thought, the execution on the business plan and rolling the company out doesn't happen the way everybody thought it was, and people get naturally upset. But at least going in, look at the personalities that you're dealing with, look at the vision that they have, and make sure that you've got a common perspective on where you want to take the company. because you will be losing an aspect of control of the company. So it's really critical that you come to grips with that, are comfortable with it, and if you are, then you can think about moving forward and taking outside money. The other thing I wanted to touch upon, and I should have earlier, is one of the things that VC will do when they come into a company is they will talk with the senior people, the founders. And you oftentimes have a situation where there's a particular individual or two or three that have started the company, and they might up to this point be sitting in the positions, the senior level positions, the CEO, the CFO, or whatnot. It's really important that, let's say you're more of a technical person, an engineer, you've started this company, you're great at the technology side of it, you've really never kind of taken a company and taken it through the process, built it, raised capital, and taken it and executed on a business plan. VC will oftentimes come in and talk to you about that. And they'll ask some fairly probing questions. And for example, one of them will be, are you comfortable stepping aside as CFO of this company, or CEO in particular of this company, and becoming, say, the CTO? And if the knee-jerk reaction or the real sense is from that person that, no, I'm going to be the CEO. I started this company. It's my company. I'm going to run it. If they look at that, they don't believe you have that acumen to be that, to take on that role, they'll walk. And understandably so, because the investment in the company is just the beginning. It's the execution on the plan that is critical. And if you don't have the right people, I always say it's kind of the right people on the bus, but it's also the right people in the right seats on the bus that are critical to the success of a company. And VC will look at that very hard. And if they feel like they're dealing with somebody that is just intransient about, I'm going to run this company, it's my company, under no circumstances do I want to step aside and become, say, the CTO versus the CEO, oftentimes they'll walk from the deal because they know that's not going to end well. So that's another thing just to consider as you go into this process of raising capital is, are you comfortable giving up partial control, because you will, with these outside investors, but also taking on a different role within the company. And again, when I'm advising clients, I really come back to the perspective. I mean, if you want this to succeed, if your goal is really for your idea to become more than an idea and to become a successful venture, then don't you want the right people in the right place within the company taking that to the next step? Isn't that the ultimate goal versus more of a personality thing of just being intransient about, I want to be the CEO? And so, again, something to think about before you get into this process, because that will become another factor that basically causes a venture capital group to walk. And I've seen it with some of my clients. And you're just going to have to raise capital a different way if that's invariably what you're looking to do. There's other what we call contractual rights that exist with preferred stock when you do deals. We call them information rights. Typically, the preferred shareholders will have rights to financial information on a quarterly basis, and then sometimes, depending on the size of the deal, they'll insist on audited financials on an annual basis. Sometimes we're able to negotiate that aspect out of it because it's expensive to do audited financials, but information rights is something that they will expect to see. Registration rights, they're in every deal with preferred shareholders, but I would say 5% of the time do they ever come in play, maybe 10%, because it's mainly something that comes into play if there's an IPO, because it has to do with registration rights in an initial public offering. And even then, the underwriters of an IPO will come to play, review those registration rights, and seek to amend them, change them. So we don't really spend a whole lot of time on it, but that's the relevancy or when they come into play. Next area is preemptive rights and rights of first refusal. Preemptive rights basically gives a preferred shareholder the right to participate in future rounds of financing. Again, the whole concept being that, hey, right now I'm a 10% owner. If you're going to do another round of financing and it's an up round, I want the right to maintain my 10% ownership and that's what a preemptive right means. It's like I have the right to buy enough shares in that next round of financing to maintain my percentage ownership. Rights of first refusal, basically what that is that if somebody, like a founder, is interested in selling some of their shares in a financing or in what we call a recapitalization, the preferred shareholder has a right to sell a proportionate number of their shares in that same deal. So basically, a founder can't get completely out, liquidate their ownership interest without the preferred shareholders having a right to participate in that financing. So that's what a right of first refusal is. Another thing is key man insurance, which is kind of a protective provision for an investor. They'll look at the key management, the founders, and as part of the transaction, they'll insist that there be a certain amount of life insurance taken out on those key people. And if that person happens to die, sometimes we actually see this with disability insurance too. The beneficiary of that life insurance is the company. And what the company that does then is, because they've just lost a key individual, they'll use those funds to try to do a search to bring in a replacement for that individual, and it's funded by that key man life insurance. And so as part of the deal, the company agrees to pay for the key man life insurance premium on some of the key individuals in the company. The other thing is, and I touched upon this earlier, is one of the things you really need to make sure that's in place, employee and consultant confidentiality agreements. One of the requirements to closing the deal will be that all of your employees, assuming you have employees at that time, and all of the people you've been dealing with on the outside that are consultants that have been doing work and providing IP and other things to the company, sign a confidentiality agreement and also make it very clear in those documents that whatever they've created is now owned by the company. So again, these are what we call conditions to closing. That will be required in order for the financing to close and for the money to be funded into the company. The rest of the handout is just a sample of a term sheet, just to give you an idea of what they look like when you're going to get presented with this. So you can take a look at it, but essentially it starts tracking a lot of the things that I just covered as far as the terminology you're going to see and the types of things you're going to negotiate. There's honestly a lot more that goes into these nuances of each of these different provisions and types of provisions for a VC term sheet, but I'm sure at this early in the morning you've heard enough kind of Greek language. Hopefully just give you a perspective that you want to have people involved that understand how to do these deals, because if you do them without somebody that's really knowledgeable about first of all, not just what this different terminology means, but somebody that does this enough to understand what are the market terms, current market terms. Because depending on the conditions of the market, is it a pro-company market, is it a pro-investor market, these terms will soften or harden. They'll get more stringent or less stringent. And you want somebody that knows basically where the trends are. Is full ratchet something that's coming into vogue, or is that something that's still draconian? Participating and non-participating, liquidation preferences. So somebody that does this a lot will know what is market, what is not, and it'll help expedite the process, because again, if somebody doesn't really understand the process or the market, they'll become more of an inhibitor than a helper in that process. They can kill the deal by themselves if they don't know what they're doing. So it sounds self-serving, but it really is something that you should really make sure that you can locate the right people to surround yourself with, because they really can be a value add beyond just being somebody that has knowledge of terms and maybe being able to negotiate a deal on your behalf. I know it's a ton of information in a short period of time, but the handout kind of summarizes it. If you guys have questions later and you want to email me or just get on a quick call, I'm happy to try to explain some of it more. But it is it's an exciting area. When you're a startup person, if you haven't been through it before, there's just a ton to learn. And Martin and I were talking earlier about, this whole weekend and event is about is educating yourself. Knowledge is power, and the more you know about this process, and I'm not saying as deep as that I just went through, but just if you know enough to issue spot and go, okay, I remember Brent talking about this. I better find somebody that really understands what this preferred stock means, and have somebody that really understands how to negotiate these deals and find the right person and bring them in. That's really what it's about. You're never going to know, or should you know, as much as say I do or somebody else does that does this all the time. But it's about finding that person when you need them. And the same thing for entity setup, whether it's an accountant or lawyer doing that for you, stock option plan set up. Find somebody that does it, and ultimately they will bring value way beyond just the value of knowledge that I've just gone through. But they'll be able to guide you in the right direction. We really try to help startups and even a lot of my middle market size companies way beyond just the law side. It's introductions to VC, to investment bankers, to the right accountant, business valuation. We won't get into that. They may have talked about it in the stock options. It's become more and more critical even for privately held companies because of this section called 409A. There's just a lot. And the more you can understand that and just issue spot, I think the more it's going to help you in the long run to be successful. It's not easy. I told a couple of you, 7 years ago I started my own company, and I've been on both sides of this, the lawyer, and now I'm the entrepreneur. And it's actually really helped me because now I've seen it from both sides, not just representing entrepreneurs as a lawyer, but being one. But you wear a ton of hats. And we're here as professionals to help you identify issues and minimize mistakes, because a lot of startups fail regardless. But we want to try to be here for you to minimize what can be done to make those mistakes, and to try to help you through the process such that you're going to have a better chance of succeeding and be able to raise money and realize the vision that you've created through your business plans. And so that's, again, kind of my role as a corporate lawyer, is to try to help you through that process. So I don't know if you have questions, but that's kind of the summary of what I wanted to go over. Yeah.
Really good. Yeah. So, I think about, startup weekend people. Come Monday, they want to form some kind of a corporate entity. What's it going to look like? Is it going to be a C corp, an S corp, an LLC? The pre-funding,
Yeah.
unfunded. Maybe we'll get some friends, family, and fools to put in a couple of bucks, but.
It's interesting. We get that question a lot. I guess my first response would be, if you don't feel like you need a stock option plan kind of near term, where you want to use it for outside directors, outside advisors, or even people you're trying to compensate with stock versus cash, probably an LLC, because they're really easy to set up. It literally takes an LLC-1. It's a one-page document. If you have relatively few people involved, it almost can be just as simple as that. There is a document called an operating agreement, but there are default provisions in the corporate code that exist that can govern the operation of an LLC early on, and it's a pass-through tax entity. If you want to, do a stock option plan, I would highly recommend, and you have the right type of shareholders, because there are certain shareholders that can't be shareholders of an S corp. I'd form a corporation and make an S corp election. And then as soon as you bring on what we call a second class of stock, which would be preferred stock as an example, it automatically converts to what we call a C corp. So it really depends. I'd still say that about 90% of my clients that are early stage or startups candidly form C corps. And it's kind of funny because I think if you talk to an accountant, they'll tell you LLC. If you talk to me, I'd probably tell you a C corp, and that's really the reason. So I think it really depends, and it is easier to start with an LLC and convert to a corporation. That's a pretty simple process. It's a little harder if for some reason you start as a corp and want to go back to an LLC. Yeah.
Your companies are incorporating in California?
Most, but some in Delaware, and I don't know if you're familiar with why, but Delaware corporate law is a little more friendly toward corporations, but it really has to do with shareholder derivative actions. The case law is a lot clearer in Delaware than it is in other states on that particular issue. Sometimes you have VC that like Delaware corporations, although I've seen both. I mean, I haven't seen it too many times where a VC comes into place and kind of as a condition to funding your company forces you to what we call reincorporate in Delaware if you're a California corp. Most of the time they're okay with it. As long as you've got the right indemnity language, E&O, what we call errors and omission insurance in place, they're going to be okay with a California corp. The thing to remember that as you form in Delaware, you've got to qualify to do business in California. So you're still paying a fee to qualify here. And so for that, yeah, for that, I just think sometimes it's easier to do California because, you know, what will happen is it's not that expensive to reincorporate. So if you form in California and want to do a VC deal, and for whatever reason that VC is just going to force you to reincorporate in Delaware, you can do it then because you're getting the money to cover whatever incremental expense there is to do it at that point in time. So again, probably 90% of my clients are California. I know you've probably heard from some people, what about Nevada? You know, we talk about that, and there's no income tax in Nevada. If you form in Nevada, but all of your operations are here, you're going to pay income tax. Don't even think about Nevada unless your entire operation is going to be in Nevada. Same thing with any other state. So it's really, I think, comes down to if you're located in California, California and Delaware as your choice of entity. Yeah.
Has anyone mentioned Wyoming? People have been telling me Wyoming.
Same. It's going to be the same thing. I mean, again, if you're going to go out and raise capital, you want to be in states that traditionally VC and investors are familiar with from a case law perspective and other perspectives. And if you're located in California, I don't see any advantage to really forming in a place like Wyoming, Nevada, Washington, Florida. It's really going to be Delaware and California are the two. Yeah, you do. Actually, that's a great point. If you do that, that will be something that an investor looks at and go, well, you don't have people involved that know what you're doing, and that's not an impression you want to give somebody.
What kind of advice would you give for young entrepreneur? A lot of times to get going, they need some seed money, right? Just to do the basic stuff, and the only place they can go to are friends and family. So what would be your advice to them to use friends and family money without setting up a big alarm when they go to the VCs? How should they set it up?
Well, I mean, I think the first thing is that your goal is to try to be successful. And, when you go out and raise money from friends and family, first of all, you don't want to damage the relationship where you have them. They've got to make sure this is money they can lose. They're investing in a startup. But your goal is to take that seed money and try to move your company along where it's showing progress. It's something you can show then to angel investors that I went from A to C on $100,000 from friends and family, and we're really making good progress. So now I'm ready for an angel group to take a look at us because I need $250,000 or I need $500,000. Friends and family is an interesting thing. I'm always a big proponent. I know this is tough to do sometimes. The fewer people involved in your company, the better. I'm never a big proponent of, I'm going to go out and raise, $100,000 from 30 different people because you've got securities law issues too. And I'm not going to get into that, but we have this thing called accredited and non-accredited investors, and it just muddies the waters, and it'll impact again your ability to raise capital from more sophisticated groups, angel investors, VC, if you've just done some funky things early on and raised small amounts of money from a bunch of different people. And I will tell you now that if I'm an angel investor or a VC, I'll look at that and go, I'm going somewhere else because I don't want to get in that mess. So I guess my best advice, there's no perfect answer, but is try to really have a well thought out business plan before you raise that seed money and have it really, a pro forma financial about what you're going to use that money for and where you expect it to get you in a certain period of time, as far as product development and other things, and position yourself to get to the next step on the least amount of money when you bring in that next round of VC. But Martin's right. And as I already talked about, there is that. I think it's an even more difficult place when you get to that kind of black hole of where you need to raise more than $1 million but less than $3 million. That's a really hard place to be in trying to raise capital because it's too small for most VC. There's a few small VC funds that play in that space, but not many. But it's too much for family and generally too much for angel investors. And it's this ongoing struggle that startups have to find funding in that gap. The other thing is it's really been interesting, I think, since 2007, 2008, when we went through the real down economy, that both VC and angel investors are much more cautious about investing in companies. They want, and it's tough when you're a startup, they want customer validation. They want revenue. But I'm not saying it has to be a lot of revenue, but if it's revenue from the right group or even a test with a prospective customer that is a real player in the industry that gives you validation that you're moving in the right direction, that's a huge leg up for you as a company. But even angel investors now oftentimes are looking for companies that are further down the path than they used to be and want to see, some type of actual product. Not just an idea, at least a prototype or something that you're in the market with, testing at companies, which just makes it even more difficult to raise money in this market because they are much more reticent to get involved in early stage. So just, unfortunately, another challenge.
A related question to that, there's this crowdfunding apparatus out there now, right? So if a company gets started with crowdfunding, what are the chances of that same company getting venture guys to step in when there's so many shareholders?
Yeah, I think that's going to depend on the number of shareholders. That's going to be an interesting dynamic because obviously the law has changed just recently to make it a little easier to do crowdfunding. The securities laws have changed. And I think some people believe, depending on the amount that you can now raise through crowdfunding, that's maybe it's going to fill that gap of the 1 to 3 million raise. I think it comes down to this, Martin, is if you've got a really interesting product, and if you surround yourself with the right people to address now having 60, 70, 100 shareholders, which is going to be different, I think you're still going to get VC interested. And I guess one of the advantages you have is that you're not going to need them maybe as much. It'll be interesting how crowdfunding affects VC funding, because to what extent will it replace an aspect of it? I don't know yet. But it'll be interesting as that plays out and more companies try to pursue crowdfunding versus the traditional route. I do know in the life science companies that I've been doing a lot of work for in this area lately that they're going non-traditional and actually getting a lot of money in from Asia. I'm not saying that's necessarily for this group or for the people that are here this weekend, but companies really, if you can avoid the traditional VC route, I'd be the first one to tell you to do it. I mean, it's a pain. You can count on at least it taking probably 6 to 8 months from the time that you really say, hey, I'm going to start this process to actually closing the deal with a VC. It's time consuming and it's distracting because trying to raise capital and trying to run a startup, is really a lot of work. And you'll see that when you get into it. It's a lot of work to run a startup. But then when you add the fact that you're having to go out and present to VC or angel groups and trying to run your company at the same time, it's a real burden. So I've been fascinated about how, at least in the life science space that I've been working in, that they've raised 20, 30, $40 million on common stock, which is really incredibly unique. And they've done it based on relationship. Yes. Hi.
Is there a criteria well established
you know, it's free market. You know, it really comes down to you coming up with your rationalization. But at the end of the day, it's going to be, is there an investor out there that believes in it as much as you do, and you negotiate it? So I don't, you know, pre-money valuation on an idea or even an early stage company is so difficult. And that's why the further you can get down the road before going after that institutional money or even angel money, the better, because then you have a basis to justify a higher valuation and minimize. What I would tell people that have not been through this process before is
We're gonna have to go inside.
be less concerned about how much of your company you're giving up in a deal than the value that money might bring down the road to the company you're running. In other words, you know, you could sit there and go, well, they didn't think my company was worth enough. I didn't want to give up 30%, so I didn't do the deal. And I still own 90, 100% of a company. Well, that doesn't work out real well if that company a year later is still not worth anything, where if you had taken the money, it would have been worth $20, $30 million, and you only own 50% of it. So it's not, you know, how much you own. It really comes down to how much is that ownership worth later. And it's a hard thing to come to grips with or appreciate or accept, but I think it's really critical for startup executives to just understand that. You're going to give up a level of control regardless if you're going to take on VC money. So isn't the goal here to increase the value of what you still own? Yeah.
Are you encouraging your clients to take convertible debt for those scenarios?
We try to sometimes. I think it's a good point. We didn't really talk about convertible debt. But if that is a way to give the investors some comfort that they're not equity, and so at least to my point earlier about liquidation, if the company goes under, at least they're a debtor, they're not, or a creditor, they're not an equity owner. So that is something that oftentimes kind of bridges that gap of concern, and then you just negotiate what the conversion is, and maybe it's the terms of the first round of financing, and they convert into that with some warrant coverage on top of it. Yeah, so that's...
For our companies, it's exactly what we
Yeah.
encourage to do. At such an early stage, you can't really put a dollar on the
You
item
can't.
at this point. So
But you let somebody later on do it for you. Yep, that's a good point. Yes?
I'm only familiar with crowdfunding such as Indiegogo and Kickstarter, and I don't believe they take their shareholders, they're just donating.
They're not. That's different. So they're basically, and that's an interesting way to launch products, and I think people should look into it, but they're basically offering product or other things as part of like Kickstarter, as part of their raising the money. There is no equity being provided, which I think is really an interesting way to look at raising money to build product prototypes and try to launch a product. Crowdfunding is actually different. It is actually taking cash for equity from a larger group of people, and the whole issue around it is that you're kind of doing this I hate to use the term, it's like a public offering in a sense, because you're on the internet, you're talking to people about it, and there's been a real limit on companies' ability to do that because it's a pseudo public offering. The Securities and Exchange Commission has been really apprehensive about how it's done. But now there's been some loosening around how companies can do that. And so I haven't been through the process yet because the loosening of the regs has occurred relatively recently. But more and more companies are at least looking at it as a way to raise capital for themselves. But it is actual cash for equity.
Well, what are some of the more reputable crowdfunding companies that I don't know about?
You know, I'm trying to remember some of the ones. Martin, have you?
Flash funding,
Yeah.
or flashfunders.com, I can't remember.
Right. Yeah.
They're here in LA.
Yeah, because product for crowdfunding using product can only, it really works for consumer.
It's consumer branded driven because you know, Kickstarter and that type of thing, it has to be something that somebody wants to, you know, as a consumer brand or something else. The technology side of it, it doesn't work well for the Kickstarter model unless it's a technology that's kind of consumer related, like it's electronic or something that you might use.
Getting ready to launch a Kickstarter campaign, but it is consumer.
Right. I think it's a really interesting way to do something.
We have quite a few AngelList syndicates that will all also pull into one company as well.
A few.
Look at AngelList. It's got a variety of syndicates. AngelList, yes. This is, raise a third of your fund financing before approaching AngelList, but prominent angel investors are always on AngelList looking for.
So ANGELLIST.
Yeah.
Okay, thank you.
Angel.com.
I was just, I mean,
I mean, it
So
depends.
what do you to sort of, you know, move to preserve as much these options as possible?
Well, the way, I mean, the way you do it is, I mean, you look at alternatives. You look at friends and family. You look at Kickstarter. You look at crowdfunding. You look at other ways to raise capital. And like I said,
Avoid it, basically.
to avoid getting to a point where you're dealing with institutional investors. And you try to get, you really try to use the capital you do raise to move the process along as quickly as possible to get to a point where when you do have to deal with VC, if that's the route you're going to go, that you can get a good valuation for your company and not give as much of it up. But you know, there's luckily for companies nowadays, there are a few more options available in raising capital. But you come back to looking at your business plan and what is it you're going to need to raise. And obviously, the less you need to raise to move yourself down the process, the better. And if you can do maybe some debt funding and other things, that's not a bad way to go if you can find people that'll do it. Yeah, so I mean, it's not, you know, sky is falling, but I think it's just important for people to understand that if you do choose this route, I mean, you're doing some things that are going to give up control of your company, but that's why I touched upon the fact that it's so important to find the right group that invests in you, and hopefully that relationship works out. And at the end of the day, the reality is if the company's successful, that relationship is going to work out. It's when the company's unsuccessful that things get ugly. It's just, I mean, that's just the honest truth of how things work. So you do your best to, you know, be positive about it and be successful, and that all comes back to the right people on the bus, the right people in the right seats on the bus, and a really well thought out plan, and then execution. And that's what this is all about. It's like at least start out, you know, with doing things the right way. Because if you don't start out doing things the right way, the chance of you doing things the right way later on are just going to be more problematic.
Well, thank you very much.
Sure.
It was very